Your mortgage is fixed, your payment is not. And if you have just opened up an envelope from your servicer that said your payment is going up $354 a month on a loan where the interest rate literally cannot change, you're not crazy and nothing went wrong. I want to show you an actual escrow analysis. Same house, same loan, same rate. In 2021, this payment was exactly $1,500 a month. This year, it's $1,854. Now, here's the part almost nobody gets told, and it's the reason I'm making this video. The $354 increase is not one increase. It's completely different things stacked on top of each other. One of them is permanent. The other one expires automatically in 12 months. And more than half of your increase is the one that expires. Nobody tells you that. So people look at their letter, decide they can't afford their home anymore, and quietly stop doing the one thing that was actually building them wealth. By the end of this video, you'll know exactly which half is which, why it happened, and 5 specific moves that get real money back. I'm David Lurvy. I'm a licensed mortgage loan officer, and this is the letter I get the most questions about all year. Quick favor, if this is helping, tap the like button and subscribe if you want more of these. 2 people in the comments on my extra payment video described this exact thing. One said their payment was $1,551 and taxes and insurance took it up $500. The other said they've been paying $1,000 extra every month and stopped because their insurance went up 5 times over. Both of them were told the number and never told what it was made of. That's what we're fixing. Let's open the letter. First, what's actually in your payment, because 4 different things are writing in there and the one of them is fixed. Principal and interest, that's the loan. On this loan, it's $1,079.31 and that number does not move for 30 years. That's the part your fixed rate protects. Then there's your property taxes, then there's your home insurance, and then there's your mortgage insurance. Those last 3 don't go to your lender, they go to your servicer. They collect them on a monthly basis, hold them in an account, and then pays your county and pays your insurance company when those bills come due. So your mortgage payment isn't really a mortgage payment. It's a mortgage payment with 2 bills you don't control taped to the side of it. In 2021, on this house, taxes ran $3,410 a year. Insurance was $1,638. And those divided by 12, the escrows is collecting $421 a month. Plus the loan payment, $1,500 even. 5 years later, same house, the tax bill is now $4,604. Insurance is now $2,405. That's $584 a month in escrow instead of $421. So the true permanent increase here, the amount your payment generally went up forever is $163.39. But the letter says $354. So where's the other $190? This is the part I really want you to understand. Your servicer only reviews your escrow account once a year. And when they set your monthly escrow amount last year, they set it using last year's tax bill and last year's insurance premium, because those were the only numbers that existed. Then during the year, your county sent a bigger bill, your insurance sent a bigger renewal, and your servicer paid both of them in full, on time, out of an account you were funding at the old smaller amount. So the account ran dry. Not because you did anything wrong, because it was collecting for a world that stopped existing in month 3. The regulation that governs all of this is Regulation X12 CFR 1024.17, and it calls that a gap shortage. It defines it as a quote, an amount by which a current escrow account balance falls short of the target balance. On this loan, the shortage was $2287.49. And here's the mechanic that changes everything. Under paragraph F3, when your shortage is bigger than 1 month of escrow, your servicer can spread it back over 12 months. That's your other half. That's the $190. So look at what the letter is actually telling you. $163 of increase is permanent. That's the new cost of your taxes and insurance. $190 of it is you paying back last year, and it comes off your payment automatically 12 months from now. 54% of that payment shock has an expiration date on it. Your payment is scheduled to drop back to $1,663 on its own without you doing a single thing. I'd bet almost nobody who got that letter this year knows that. And it changes the decision completely. $163 a month is a budget adjustment. $354 is a crisis. Those two numbers make people do very different things. And the only one of them is the real one. The whole reason this beats people up is the letter reports a total and never shows the parts. Your servicer isn't hiding it. They just printed a bill for last year and an estimate for next year on the same page, added them together and put them in a sum in bold. So if you're sitting there running this on your own letter right now, hold that thought for about 30 seconds. And real quick, that's the whole pitch here. Today's video is brought to you by me. There's no sponsor in this video. This channel is my business. I'm a licensed mortgage loan officer. And if you're buying or refinancing in the next few months, this is generally what I do all day. So book a free 15-minute call with me. There's a link in the description. There's no pressure, no pitch. I'll just walk through numbers with you and then tell you what you really qualify for. Want to run it yourself? My free payment calculator is linked down there too. And if a call feels like a lot right now, just email me. It's on the screen. I read them. Scan the code on your screen or tap the link in the description in the pinned comment, which is the comment at the top. All right, let's get back at it now. Now, one piece of that shortage, because it's not purely last year's shortfall. Your servicer also is allowed to hold a cushion. The regulation caps it, and the cap is worth knowing. 12 CFR 1024.17 paragraph C12 says the servicer may add an amount to maintain a cushion. Quote, no greater than 1/6 of the estimate total annual payments from the account. 1/6 of the year is 2 months. That's the legal ceiling, 2 months of escrows and not a penny more. On this loan, the cushion cap works around 1168, which gives you your first real test. Take your annual taxes plus your own insurance divided by 6. If the cushion on your analysis is bigger than that number, your servicer is holding too much of your money, and you should be on the phone with them today. Now let's talk about why these two bills moved, starting with one that makes people the angriest. Property taxes went up while home values went down. That's not a typo. The 2025 property tax report from ATTOM published this April found that average single-family home carried $4,427 in taxes, up 3%, and the average value fell 1.7%. Total taxes levied on single-family homes hit $396.8 billion, up 3.7%. The effective tax rate nationally went from 0.86 to 0.9, the highest it's been since 2020. So your house is worth less and your tax bill is bigger. That happens because your assessed value and your market value are two different numbers on two different clocks, and because your county's budget doesn't shrink when your Zillow estimate does. If values drop, the rate goes up to cover the same spending, which means the number on your assessment is a claim, not a fact, and claims can be challenged. Hold that thought. It's the move here. Insurance is the other half, and it's the one that's generally gotten ugly. Home insurance rates rose 46.8 cumulative from 2020 to 2025. That's per LendingTree's State of Home Insurance report in June. The single worst year was 2024 at 12.7, and then 25 at 6%, nearly 50% in 5 years. On a bill most people have never once shopped since they closed. And noticed what that means. You could have done everything right, never had filed a claim, never missed a payment, and still paying almost half again what you paid at closing because there are hurricanes in the states you don't live in, and rebuild cost on materials you never buy. Okay, 5 moves. These are in order of how much money they get back from your effort. Move 1, read the actual analysis, not the summary line. You are entitled to this. 10.24.17 paragraph 1 says the servicer must submit an annual escrow account statement to the borrower within 30 days of the completion of the escrow account analysis computed that year. It has to show you what came in, what went out, and what they projected in for the next year. Most people read the new payment on page 1 and file it. The number you actually want is the page 2, the shortage. Find it and confirm the split we just did, permanently versus temporarily. If your servicer's projection assumes another big increase next year that hasn't happened yet, that's a phone call. Move number 2, ask to pay the shortage in one shot. If your budget can absorb it, this is the highest leverage call you can make. On our loan, writing one check, $22.87, kills $190 a month immediately instead of carrying it over the year. Your payment drops to $16.63 a month instead of next spring. Most servicers will take a lump sum shortage payment if you call and ask. It's not automatic, and it's not something they'll offer you. You have to ask for it by name. Move 3, appeal your assessment. Your county has a window, usually a few weeks after assessments go out, and most people miss it because they didn't know it exists. You are not arguing that your taxes are too high, nobody cares. You're arguing that the assessed value is wrong, and you win that by showing comparable sales that came in lower. On this house, winning a 10% reduction takes the tax bill from $46.04 to $41.44. That's $38.37 a month permanently for maybe 2 hours of work. And when values are falling while assessments are continuing to catch up, more of these appeals are winning than usual. Move 4, reshop the insurance and look hard at deductible. Loyalty is not the reward here. Get 3 quotes at identical coverages, not lower coverages, identical, or you're not comparing anything. Ask about bundling and ask what raising your deductible from $1,000 to $2,500 does to the premium. Because on a lot of policies, that one change is worth more than switching carriers. Save 15% on this one and you're down to $30.06 a month. Stack moves 3, 4, and you've clawed back $68.43 a month against a permanent increase of $163. That's 42% gone, and it stays gone. Move 5, ask whether you can waive your escrow entirely and pay the bills yourself. This one has the most fine print, so let's be straight about it. Who it's actually available to. If you're on a conventional loan and your loan is under 80% loan to value and you're current, a lot of lenders will let you drop escrow, sometimes for a small fee. Then the money sits in your account earning interest instead of theirs, and you pay the county directly. But if your loan is what's called a higher priced mortgage, Regulation Z 12 CFR 1026.35 paragraph B require that you do have an escrow account. And paragraph B3 says you cannot even request cancellation until 5 years after closing. And only then if your balance is under 80% and you're not delinquent. And if you have an FHA loan, escrow isn't optional at all for the life of the loan. So if that's you, moves 1 through 4 are your whole toolkit, and they're still worth real money. If you're FHA and you're also carrying mortgage insurance, you cannot shake the exit is refinancing to conventional once you've got the equity. And I've got a whole video on when that math works. Now let me zoom out because there's something bigger in this data. Your Your principal and interest is the only line in your entire housing cost that holds still. Everything wrapped around it is some of the fastest inflating stuff you own. Over the last 25 years, inflation overall is up 1.87. Your P&I is 1 forever. That's worth sitting with because it reframes what a fixed rate mortgage actually is. It's not just a payment, it's the one bill in your life that inflation cannot touch. In a category where everything else is running away from you, rent over the same 25 years went up 2.33 times, and it has no ceiling at all. So the fixed part is doing the job. It's just doing it quietly while the loud part gets your attention. And that brings me to the thing this letter actually cost people, which was nothing to do with money. Remember the guy who was paying $1,000 extra a month and stopped? Let's price that. 5 years into the loan, the balance is $221,041, the 25 years to go, and $300 a month to just $300, and it's paid off in 17.7 years. $300 a month buys you 7.3 years of your life. That's what actually walks out the door when the escrow letter convinces you that you're broke, not the 354, the habit. So here's what I genuinely do. Take the hit this year, run moves 1 through 4, and get back what you can. Then put a reminder on your phone for the month that your shortage falls off, because $190 a month is about to reappear in your budget, and you will not notice it unless you're looking for it. That's the month you restart the extra payment. Your rate is fixed, your payment isn't, and now you know why and which half of it is temporary. The letter isn't a verdict on whether you can afford your house. It's a bill for last year and the estimated for next year printed on the same page. And the whole trick is being able to tell them apart. You can do that. I'll see you in the next one.